Good evening, you're tuned in to Bloomberg Quint Live. My name is Ayush Elavadi. There's been a lot of action today. Here are the headlines. Indian equity benchmarks rose to record highs led by gains in Infosys and Bharti Airtel as investors await corporate earnings for the December quarter. Crude prices extend gains from three-year highs. Global head of commodities at Goldman Sachs, Jeff Curry, says the OPEC will look to prop down prices if crude jumps above $70 a barrel. IndusInd Bank reports a stable third quarter. Asset quality sees a mild uptick. Reliance Jio is likely to report its first ever quarterly profit in the third quarter. That's a Bloomberg exclusive. Bangalore-based ad discovery platform InMobi makes its biggest acquisition yet, buys out Los Angeles-based startup AirServe for $90 million. Well, let's start up straight with the market action. Neeraj is standing by to take us through all the action of the last day today. Neeraj, there seems like a lot of green in and around you.
Well, there's a fair bit of green on the bourses as well today, though you could argue that it was a flat day of trade. So essentially consolidation for the large caps, mid caps too, pretty much in the same vein, and which is why the market breadth wasn't terribly impressive. It's just about even Stevens. What did well and what didn't? So since we were talking about green, I think technology continued its gains. You could argue mixed bag again out here, but Infosys and Tech Mahindra continues the robust move. So good moves there amongst the top gainers on the index. And amongst the top gainers on the index were also some comeback boys of sorts. iShares, it's been having a few indifferent days today. A good solid 1.5% kind of a move. Bharti Airtel had about 1.5% kind of a move as well. So those two did well for themselves. What didn't do well was IndusInd Bank. Post its numbers came off about a couple of percentage points lower, and it also had a collateral damage on Bharat Financial naturally. So both of these stocks came off post in the next 1.5 hours after the announcement of the IndusInd Bank numbers. I don't know if it's asset quality disappointment or otherwise, but yeah, both the stocks came off today. This was the big news maker, by the way. What did do well at the broader end of the spectrum, I think real estate and the nature of the rally or the nature of the movers was different. We haven't quite seen Oberoi Realty and Godrej, while they've done well, be at the center stage. It's always been the fringe players which have been out there. Now the two large boys from Mumbai make their presence felt. Oberoi up about 5%. Godrej didn't do too badly, so these did okay. Also, on those rumors of impending or coming up merger, IDFC Bank and Capital First, both of them shot up in trade. They say no smoke without fire. Let's see if there is indeed a fire that comes about a bit later on. Last but not the least, one key loser in trade. There were a clutch of them, but one key loser was Fortis, which corrected about 7.5%, was the top loser on the Nifty 500. Back to you.
Neeraj, really interesting market wrap today. Thanks so much for that update. Now, the shale revolution is the offsetting force to the strongest economic growth witnessed since 2004, says the global head for commodities at Goldman Sachs, Jeff Curry. In a conversation with Bloomberg, he adds that a further rise in oil prices will prompt central banks to respond to the inflationary pressures. Listen in.
The key is really where the forward price is, not where the spot price is. And I go back, forward prices 1 year out are trading somewhere around 61 to 62, cost basis of 50, 55. That's what they're targeting. If you can keep that back end anchored, that front end can do whatever it wants, because the investment in the shale does not take place on that front end price, but rather on that back end price. Now, in terms of where do they want prices to go, getting too far above 70 starts to create the risk that central banks respond to the inflationary pressures off of higher oil prices. I would tend to think that OPEC members do not want to see that, and that in general we'll probably see more noise and rhetoric if prices trade above $70 a barrel in the coming days to push this market back down to lower levels. But I think the real key here is look at those forward prices. Where are they anchored relative to the price? Because that's the signal for investment, not the spot price.
Well, IndusInd Bank's profits met analyst estimates in Q3, while its asset quality deteriorated marginally. Net profit rose 24.7% year-on-year to 936 crore rupees. Net interest income rose 20.1% to 1,895 crore rupees. MD and CEO of IndusInd Bank, Ramesh Sopti, says that while the capex is still patchy, he sees a strong growth in working capital demand and buzz in the economy once more.
I think there's a very firm trending that we are now seeing And from the initial trending of working capital, we are also seeing capex building up of the nature that I explained to you. So I think there's a firm trending now. We can see, and you can see the numbers yourself. Credit growth doubled to 10.6% from 5%. Capex is a little patchy. It's here and there, but there's definitive trending on working capital. And even if retail had grown 17%, overall credit could not have grown 10.6% if corporate was not growing. So there is a pull, certainly. I mean, you can feel the little buzz coming back into the economy.
Well, my colleague Shraddha Babla tells us how has Q3 been on a whole for Indus Bank in this report.
Well, IndusInd Bank numbers were broadly in line with estimates, but there was a small or marginal uptick as far as the gross NPAs are concerned, but not of too big a concern. I'll just run through the key numbers first. Net interest income grew by 20%, net profit grew by 25% to 936 crores. Net interest margin came in at 4%, but the gross NPA number came in at 1.16% versus 1.08% that we had seen in the second quarter. So slightly inched up. Rise in the NPA, however, the management said was spread across books and not on account of any single account. The good part is that the CASA traction continued in this quarter as well, and the CASA ratio now stands at 42%. It has already exceeded the 40% target that the management had set for March 2020. Loan book growth came in line at about 25%. More importantly, there was a positive commentary coming in from the management, especially on the vehicle finance book, which grew by 20% in this quarter as compared to 17% in the second quarter. They said that the vehicle finance disbursements have grown 34%, while commercial vehicle disbursements grown by a good 39% in this quarter. So secular growth that the management is seeing across vehicle finance. Additionally, they've also made a floating provision of about 70 crores during the quarter, and with respect to Bharat Financial, they have said that some approvals are pending for the merger. Also, they haven't received any updates from the RBI with respect to the audit. So as far as the management commentary is concerned and the numbers are concerned, both were in line, and good set of numbers from IndusInd Bank.
Well, staying with earnings, a seasonally soft quarter is likely for Tata Consultancy Services this time around. Agam Vakil tells us what the street is expecting from the numbers in this report.
Well, it's going to be a quiet quarter for TCS on account of seasonality owing to furloughs. So on the back of that, we're expecting about 1.1% sequential growth in dollar revenues and expecting EBIT margins to come in at around 25.3% according to Bloomberg projections. We could also expect net profit to grow 1.4% on a quarter-on-quarter basis. Among the factors that could influence these quarter's numbers is the subdued plays that we can see and expect from the BFSI vertical as well as manufacturing and retail especially, which has seen so much volatility over the past 1 year or so. In terms of what we can watch out for will certainly be what the management has to say with respect to the experimenting that they have carried out along with their clients in order to identify new business models, successful business models, and also their play in the digital space. But on the whole, we're expecting another quiet quarter when it comes to TCS.
Well, the meeting of the Officers Committee on GST is currently underway. The committee is likely to discuss a host of issues, ranging from removing transactions made in securities from the category of exempt supplies to widening the composition scheme to actually allow taxpayers to pay a flat GST rate. Nikunj Jori tells us what is on the agenda in the Officers Committee meeting.
The Officers Committee on GST is likely going to discuss a removal of transactions made in securities from the category of exempt supplies or turnover, a government official told Bloomberg Quint. Currently, income from securities is classified as exempt turnover since securities are neither classified as goods nor as services. So, businesses which get a part of their income from trading in securities are not eligible to claim the entire input tax credit that they're entitled for, and this leads to increasing their costs. Businesses are arguing that since the transaction that they make in securities is just a source of investment and not their actual business activity, the distinction, the classification for trading in securities should be removed from exempted turnover and they should be allowed to claim the entire input tax credit that they're entitled for. A presentation on this would be made by the Capital Markets Division under the Ministry of Finance to likely remove the classification of trading in securities from the exempted turnover or from the definition of exempted supplies. Besides this, the Officers Committee is also going to consider a widening of the composition scheme and may allow job works which are currently classified as services to opt or avail the composition scheme, which allows taxpayers to pay a flat GST rate. The Officers Committee is also likely to discuss simplification of tax returns, and this may lead to filing only one single return from the next financial year.
Well, 9 years after the Satyam scam came to light, SEBI has found the company's audit firm, Price Waterhouse, guilty of overlooking the anomalies. The regulator bars the PW network firms from issuing certificate of audits for listed companies for 2 years. PW partners Srinivas Taluri and S. Gopalakrishnan have been barred for 3 years. In addition to that, the two partners in Price Waterhouse Bangalore have been ordered to disgorge wrongful gains amounting to about 27 crore rupees. Bloomberg Quint's Menika Doshi caught up with former president of ICAI, Amarjit Chopra, to understand the implications. Listen in.
The most unprecedented move that we have had in this country. But so far as the viewpoint of PwC is concerned, let me say that there is no doubt that ICAI has the jurisdiction so far as the disciplinary proceedings are concerned. But in the entire thing, one thing was coming to light, that the institute didn't have powers to debar any of the firms, because as per the CA Act, even today, we can only debar a member from practicing or undertaking a trust function or doing some other professional work.
Now, would you say that SEBI's action against the entire PW network in India is justified as opposed to just curtailing the action?
I will say that they are all the regulators for the listed entities, and if at all they feel that public has been cheated, they could have gone ahead. One may say that ICAI should be the only regulator, but if there are certain compulsions by way of which certain action cannot be taken against the firm, probably some other regulator steps in.
No, I get it. I understand that you're saying that, yes, SEBI does have jurisdiction. I mean, I don't think even I would argue that it doesn't have jurisdiction, given that this was a listed company. I'm just wondering whether you agree with the fact that SEBI has taken action against the entire network of PW firms in India and not just the two firms that were connected to the audit.
There is no point, Manka, that we keep on acting against a particular entity only and not against the other network firms, because if they can keep on taking the attest function of the other major entities, there is no point in acting against only one particular entity, because we have PwC Bangalore, we have PwC Delhi, we have PwC Mumbai, we have PwC Chennai. I think somewhere or the other, this is one thing which needed to be plugged. And today, probably someone would start realizing, and if you look at companies like 2013, now, even when the Section 144 comes into play, where it talks of the certain services which cannot be taken up by an auditor, there it talks of all directly, indirectly, or by any other related entities. Let's be very clear about it. So the government in the Companies Act 2013 has already undertaken this particular check. So if SEBI has gone ahead and said that if one part, after all, you are sharing profits amongst yourselves, you cannot be immune, you cannot be given immunity against certain action of the certain other partners. So to my mind, there is nothing wrong.
Well, it's been a good month for automakers. December clocking double-digit sales growth across the board. Commercial vehicles, however, led the charge with over 50% growth. Krishanu Mukherjee gets us all the details in this report.
The month of December, yes, was a surprise when it comes to passenger cars, especially because the sales of passenger cars during the month actually fell by 0.2%. Now, this is a change compared to all the other categories. Looking at two-wheelers or commercial vehicles, sales grew by as much as 50% in the commercial vehicle space and around 41% in two-wheelers also. The overall sales growth across the industry in the domestic sector was 36%, but then passenger cars were lagging behind. Now, this notwithstanding, SIAM has actually revised its forecast rather upwards from what it had projected for the ongoing fiscal during the beginning of it, from 7 to 9% for passenger vehicles to the upward limit of 9%. For commercial vehicles, however, the forecast was 4 to 6%, and now because of the stellar sales through the year, especially on a low base, of course, also that point needs to be counted, but because of stellar sales, now the forecast has been revised upwards to as much as 13%. The same goes for the two-wheeler category and the other categories also. Now for the upcoming budget, SIAM has demanded a few things, one of them being that they do not want the import duties on across all categories to be reduced. Now, there have been talks within the government that the import duty on some categories of vehicles may be reduced, especially for CVs. They want it to be doubled from the existing 20% to 40%. The other demands include a reduction in, or rather an increase in the incentives that the companies are given for R&D activities, which used to be at 200%, but has now been reduced to 150%. Now, these are the demands of SIAM, and the month of December was a surprise in the passenger cars category.
In budget, first of all, every year in budget we discuss about the indirect tax, the excise duty, etc., etc. But this time, because GST Council is continuously sitting and they are addressing the indirect tax issue, that has been out of the budget preparation exercise. So we are left with only the direct tax and the import duty. We have talked about both direct tax and import duty, not a very significant recommendations, but we have talked about that please do not reduce the import duty on CBUs, the complete built unit. Please keep it at the same level for passenger vehicles, two-wheelers and others. For commercial vehicles, we have said that in fact the duty should be increased from current 20% to 40%, because actual duty is 40%, but through an exemption route, the government has kept the duty at 20%. We are saying that please go to the 40%, what was originally announced. And we have, in fact, in WTO also our bound rate is 40%. So we can easily go up to 40% and keep it at 40%.
Bangalore-based ad discovery platform InMobi has made its biggest acquisition till date, buying out Los Angeles-based startup AirServe for $90 million. But why would they make this acquisition? Nishant Sharma has the answer.
So in its biggest buyout ever, mobile advertising company and India's first unicorn, InMobi, has acquired a US-based advertising startup, AirServe, for $90 million in a cash plus stock deal. Now, InMobi said in a statement that the deal will help the company to enhance its monetization for publishers globally, and will also solidify its position in the advertising, mobile advertising market, where it competes with the likes of Facebook and Google. Now, the SoftBank-backed company, which last year announced to have achieved operational level profitability, said that with this acquisition, the company's video and programmatic business will roughly account for about 35% of its revenue.
This acquisition essentially makes us one of the most formidable platforms in the world on mobile video advertising. And it was one of the capabilities that we didn't have specifically with regards to as advertising moves to programmatic. It was not one of the capabilities that we had. So with the acquisition of AirServe, we actually get that capability and literally combine that with our large-scale presence across the world. And therefore, this is a massive deal.
Well, former Finance Minister and senior Congress leader P. Chidambaram has questioned UIDAI's move to introduce virtual IDs to secure Aadhaar data. Earlier today, Chidambaram tweeted that millions of people have already shared their Aadhaar number with many service providers. He also said that the new security layer is like locking the stable after the horses have bolted. This comes a day after the UIDAI introduced a 16-digit virtual ID to mask the Aadhaar number for a temporary period. For any given Aadhaar number, there will be only one active VID at a given time. The UIDAI hopes that this will reduce the collection of Aadhaar numbers by various agencies in a UID form. The 10-year US Treasury yield climbed to the highest level in about 10 months, leading Bill Gross of Janus Henderson Group to declare a bond bear market. In a conversation with Bloomberg's Tom Keene, Gross says he will now short US bonds. Listen in to a slice of that conversation.
We've gone short bonds, not just treasuries, but short gilts and short bunds, left the JGB market alone. But, you know, it appears that it's a treasury phenomena and treasury directed based upon your Bloomberg report this morning with China being disaffected with U.S. treasuries, and your report a day or two ago about JGBs and their change in quantitative easing policies. But nonetheless, you know, it appears a negative type of posture for bonds. I've also gone rather negative on high yield bonds and credit spreads because, you know, as yields rise, you know, zombie-like corporations pay higher yields and their spreads are compressed and their cover is compressed, and so this is not a favorable element for high yield bonds or sovereign bonds, and it's not a favorable element this morning, at least for the dollar.
You worked for years and you built for years a small shop that had enough mass where the Chinese worried about the Pacific Investment Management Company. Give us your experience of what China's doing at the margin with their treasury obligations.
Well, they certainly haven't been building treasuries, and you know, recent evidence over the last few months suggests that they've been liquidating treasuries, you know, supposedly in an effort to more diversify their portfolio. Perhaps. In any case, you know, the liquidation of treasuries as opposed to the accumulation of treasuries by China over the past few years is certainly a negative. And, you know, one of the things mentioned several days ago by your reporters has to do with quantitative easing, to the extent that the Japanese you know, are less easy in terms of their purchases of JGBs, to the extent that the ECB at some point later this year pulls back. You know, we've got a worldwide situation in which central banks in total, add in the Fed that's actually reducing their portfolio, in which the world central banks in total are not adding to their portfolio like they have in the past. There's been $14 trillion worth of bonds bought by central banks in the past 4 to 5 years. That appears to be close to an end.
Bill Gross, given your negative view on high yield and sovereign debt and so on, so where should investors go for yield right now?
Well, that's a good question because, you know, a dramatic rise in yields, and I'm not suggesting that. You know, I've suggested that once we broke the 240, 45 barrier on the 10-year, and it appears that we have, which is a long-term trend line over 25 years, that, you know, the increase is likely to be mild. I think 10-year treasuries, you know, could approach 2.7, 2.8% by the end of 2018. And what does that mean? That means another 2 or 3 points loss, and it basically wipes out all income for the year. It's not a bear market per se, but it's certainly not a bull market. You know, to be technical, bear markets bottomed in 2012 and June of 2016 at 145, and so we're 100 basis points plus higher. That could be defined as a bear market, but I think more legitimately because bonds, you know, for those years did still 3 or 4% based upon, you know, high yield total returns. That you know, the bear market that I'm talking about is a mild one, but it includes, you know, negative prices for high yield bonds.
Well, as the saying goes, whatever goes up does come down. Bitcoin resumed its slide, dipping below the $14,000 mark. The latest blow to the world's biggest cryptocurrency came from South Korea, yet again, which is considering a potential shutdown of some exchanges. Bloomberg's Eric Lam gets us all the details in this report.
In South Korea, it's kind of a continuation on a theme we've been seeing from South Korean government over the last few months. Is the Justice Ministry was speaking to reporters today saying that they're preparing a bill that would potentially shut down cryptocurrency trading on exchanges in South Korea. This has been kind of an ongoing concern in the South Korean government. The South Korean Prime Minister late last year warned that it could corrupt the nation's youth. And South Korea's become kind of a ground zero for Bitcoin trading or cryptocurrency trading worldwide. South Korea and Japan have become kind of two of the largest, most popular places for trading cryptocurrencies. So for industry investors, this was not necessarily a surprising move, but it was still a negative one. We're seeing Bitcoin dropping, some of its rivals, Ripple, Ethereum, they're also dropping as well. So definitely some money is getting taken off the table.
Well, with that, it's a wrap on this show. If you have been, thanks so much for watching, and stay tuned to Bloomberg Quint.